Hey, it's Anthony with Land Title.
This is Jim Merrion with Coldwell Banker Real Estate.
We wanted to bring you our May market update for Front Range Facts. Welcome to the show. We are going to dive right into the national market update here.
Yeah, we wanted to, just show a little bit about what housing price forecasts are for 2022 by some of the largest economists in the country. And as you can see, they average out at 9% home appreciation for the year. And this is, a recent survey, so it's taking into account, some of the large leaps we've seen in the interest rates.
Yeah. So interesting site here. When we go over to cumulative house appreciation through 2016 or 2026, it's all over the board. It looks like, Jim. What's going on?
Well, the panel, the HPES panel looks at, I think it's Home Panel Expert Survey is what it is, I believe. And, they take a look at all different economists, and even the, pessimists out of that group are still seeing a 10% increase in the national market by 2026. And of course, Colorado tends to be about double, what the national is. So, expect, to have a fairly decent, more healthy appreciation over the next 4 or 5 years with this. But, we're seeing even the, optimists saying it's going to be quite a larger increase than that. If you can go back to that slide for just 1 second, Anthony. Yeah. The optimists are saying 46.5%. I think, that's way too optimistic, but, something in between the all panelists and the pessimists is a safe assumption.
Yeah, it is. And then if you look at it year by year, I think this kind of plays it out better, right? You can see where we're at nationally at 9% kind of for the estimate for 2022. And then it really does settle down, but it's settling down back more into that, United States norm, right? We're usually sitting somewhere around that 4% range. This is a really good sign that we're moving back to a more healthy real estate market because of the hike in interest rates, because of everything that's kind of going on in the economy right now. And keep in mind, Colorado, at a time where the national economy is going up 3.5%, we're probably going to see that 5 to 6% range, which is.
And this is good for us. I mean, it's good for everybody. This is a healthier market. This is going to return to. You've heard a lot of bad things about it being unhealthy. We'll be touching upon this very idea throughout the presentation a little bit, but there's nothing bad about seeing a more normal appreciation rate, and it's going to help people just be able to buy homes again.
Absolutely. There's a Colorado slide we'll talk about later that shows a little bit about affordability index and just how extreme that's gotten. So this should really start pulling us in the right direction again. Really happy to see.
Yeah, and so I wanted to touch upon a few things now why we're really not heading to a housing bubble. And really, it's more because there's a lot of clickbait. I mean, you and I have both been noticing more and more of this clickbait idea of, oh my God, the sky's falling chicken little. Let's get some people to click on our ads so we can get supported by advertising dollars.
Exactly.
But, once you actually click those articles, if you do waste your time, they don't have any meat to it. They just have like one line from somebody saying, I'm wondering if this is a bubble or something silly. So let's dive into a couple.
So what's actually going on, Jim?
Yeah, so the home prices, median existing home price sales, they slowed down. This is great. We've been talking about how we need to see this market cool off a little bit. The whole point of raising interest rates is to deflate inflation. This is expected. This is normal. This is healthy. This is what we're wanting to see. So that appreciation rate on a year-over-year basis is now 14.8% from April of this year to April of last year, which is less than what the 19.8 or whatever it was like 3 months ago. So this is all designed, doing what it's designed to do. It's healthier. Median home prices nationwide are $391,000. Which is significantly less than what we have here in Boulder County, which is a median price of almost $1 million. And in Denver, it's like $650 or something like that. So the days on the market, it's 17 days, same as last month and the same as a year ago. So nothing has changed in that regard. So it's still essentially the same from a seller's perspective. They're seeing the same amount of turnaround time. And first-time home buyers are down a little bit. Not too surprising, as they're the ones that have the least amount of money to throw at a new purchase. And they're the ones most affected when interest rates do go up. So they went down from 31% a year ago to 28% this month or last month. And then, individual investors and second home buyers are exactly the same as they were a year ago. Again, this clickbait stuff of like, oh my God, all these national investors buying all these properties. It doesn't quite, show through the data because it's still 17%, just like it was a year ago. And all cash sales, everybody seems to overinflate the idea that there's all these cash buyers everywhere. They are 26% of transactions, but that's about the same as they were a year ago. Not much has shifted in that regard. And, when people talk about all this forbearance that happened during COVID, and then this huge like drop in sales prices because all these homes are going to be foreclosed. Well, that's the fantasy we've always said it is, Anthony. They remain historically low, less than 1% of sales, and actually down from 2% a year earlier. So that whole forbearance has really been sifted out of the market and is rapidly diminishing.
Yeah, and we have a great slide on that. So stay tuned. We're going to get into that a little bit deeper as well.
Yeah, and then the last thing is, total housing inventory. It's up 10.8% in April compared to March. That's always what happens this time of year. It's not like this is anything different. But what's kind of interesting is it's down 10.4% from a year ago. So we still have that kind of less inventory effect nationwide. And unsold inventory is a 2.2 month supply at the current pace, which is still a heavy seller's market versus a buyer's market.
Yeah, so let's talk a little bit about this forbearance stuff, because I think that's really where people are focusing, thinking that this is going to really change the world, and it's just not changing the market at all from what we can tell. I mean, look at this monthly number of loans in active forbearance in millions from 2020 to current is just dropped to nothing.
I think this is like a beautiful reflection of the changes that have occurred in the mortgage industry since 2008, because this gradual decline of things, a very orderly decline, certainly is telling, because this shows kind of what the structures and the safety nets for consumers that have been put in place since back in 2008, when there was essentially no game plan for anybody. When you had forbearance kind of ideas, it was so hard to even get modifications to loans. It was the kind of needle in the haystack to be able to get one back then. And here you're seeing the banks being able to actually do that in a very methodical way.
Yeah, I mean, look at this. This is the loans that were in forbearance throughout COVID, right? So this is June 1st of 2020 through March 31st, 2022. The interesting part here is, even with people in forbearance, 37% of them paid in full, right? I mean, they're all back paid on their mortgages. You have 44.6 who pretty much just worked it out with their mortgage people, right? Whether they deferred the payments or they modified the loan or whatever they did. We have 18.4% who are technically still in trouble, right? So they haven't really set up a plan. They haven't done anything with that. That's like the window of opportunity in the real estate market there. But the thing is, especially in Colorado, they have equity, right? So that's going to really change. It's not like 18% of homes that were in forbearance are going to go to foreclosure. It's just not going to happen.
There are about 2.3 million loans that went into forbearance, Anthony. So that's just to put a number on the map as to kind of what this whole pie is talking about. So if you have 1.3% that are in short sales due to lieu, we're looking at what, 30,000, roughly homes nationwide. So this is not bad. It's historically extraordinarily low, just from a general ebb and flow perspective.
Yeah, it is. What about this one, Jim?
Well, and that more to the point here, to follow up on that, go back to the next one we were just on, Anthony.
Oh yeah.
Yeah, there you go. So, like what we were saying, historically, this is foreclosure activity for the last 17 years, basically. And we're at 78,000 in Q1 of 2022, which is literally the lowest on this entire scale of 17 years. So we had this massive devastation of, the 2020 shutdown, and it could have gone all red again. But because we learned from our past mistakes in 2008, we had mechanisms in place, support structures in place, and federal programs in place to really help limit that damage. And this is a huge success story. This is an amazing slide if you think about it from a standpoint of how many lives this saved from financial ruin, from just horrible stress, being able to maintain kind of a quality of life that so many people lost the last time this happened. So this is fantastic to see.
It really is. It really just goes to show how much more buttoned up this entire industry has gotten since 2008. So that's really telling. And those safety nets have done miracles for homeowners. And you can really see it here too. Look at this. I mean, this is part of the reason why. These are loans that are active with a credit score under 620, right? So low qualified people. I mean, this is amazing. Like, you saw really bad lending practices back in basically 2003 to 2007, right? That whole time period where they're lending money to anybody with a pulse. And then here we are now where it's just not the case.
Yeah, the next few slides really are exploring this whole idea of how much the changes in how we do lending have saved our asses collectively in this whole COVID thing, and why we are not in a bubble because of so many better safeguards in place, and guardrails for everything.
Yeah, this is a good example right here.
Yeah. So, mortgage debt, household debt service ratio for mortgages as a percent of disposable personal income has, dropped down considerably since 2007 when it hit a high of 7.2%. So now we're down to 3.8%, which is lower than it was in January of 1980.
That's
And
saying a lot.
it is. It's huge.
Yeah.
And, even look at 1991, data compared to now where it's at that. So mortgage payments today as a percent of your income are, it sucks. Interest rates have gone up. It certainly is impacting people, especially who had tighter economic pictures, with what they're able to afford. It might have bumped people either out of the market or down to a lower price point in some cases. But on a big picture level, mortgage payments as a percent of our whole income is not that big of a deal.
Yeah, absolutely. It's a really good sign. What's going on here? So this is mortgage payments virtually unaffected.
Well, this is, if you do a refi, right? And
Yep.
what the, whole, tale of, the lead up to '08 was that everyone is using their home as a personal piggy bank. They were doing cash out refinances to do everything from, finish a basement off to buy an investment property, all sorts of things. And so it was increasing their annual costs, right? So in 2006, we hit a high where people added about $5,000 a year almost to their mortgage payments by doing a cash out refi. And, in 2012 and 13, people actually were putting more money in because they had learned that lesson. And here you can see in 2020, 2021, people were, acting like squirrels, putting those little, nuts and seeds away for the winter to kind of keep going because they weren't sure with the uncertainty of what was happening with COVID as to whether this was going to be a long time hit. So they really were conservative with it and barely raised their rates for their entire year if they did do a refi.
Yeah, so very little cash out refinances took place during 2020, 2021 for at least for our primary residences, right?
Yeah.
Yeah.
Exactly.
So this one's fascinating to me. And we've been talking about this a lot throughout the year, but the most important thing I think to recognize here is just how much has it really changed our situation? If you're a buyer, how much is the interest rates really affecting what's going on? So Jim, you want to break this down for us? And
Yeah, I think, obviously in Colorado, we have more expensive homes. The average, median national average is 391. So when you look at a picture like this, a $300,000 loan is fairly common for people nationwide. But it's pretty significant, right? We've added $500 a month to a monthly, mortgage of a $300,000 loan. It went from 1,221 up to now 1,703. So, that's a significant leap, for a lot of people. Especially as I said, like the ones that are making 4,000 a month or whatever, and this is almost half of their take home or half of their gross income. So what's interesting to see is that there was this kind of in 2021, just essentially it was flat, right? I mean, it went up and down a little bit, but stayed within a $50 range, and then all of a sudden, January 2022, it's up like $100 from its low a year before. And then 5 months, later, it's now, at that level. We're at 5.5. This slide is from, I think they gathered all the end of April data. So since May is not done yet, I've seen a lot of 5.47s and stuff like that. And it wouldn't be surprising it maybe hits 6 even by October, December timeframe of this year. So the impact may be even more, but what it is it's taking out that bottom 25% of the market, I think, to make them either go down to a lower price point or to just put things on ice for right now. But here along the Front Range, we don't have much of that market because of just the price point of everything.
yeah, and not only that, but jumbo rates are still pretty favorable. So a lot of what's going on in Boulder County, at least, you see a lot of jumbo financing anyway. So that's actually changing the situation around here quite a bit.
Yeah, it's becoming a more affordable jumbo loan than comparison to conventional for sure. And so it's we want to be sober here on Front Range Facts. I mean, we do try to kind of reflect the good and the bad. And I think what we should steal our audience for is that we're probably going to see home sale growth reduce even further. So what this is it looks essentially at every modern day recession, where every time where interest rates have increased and the economy has contracted, and you tend to see about a 10% or so retraction. This has always been talked about as being a little bit of a softer landing recession, more of a mild recession that we have coming up, most likely. And the numbers seem to bear that out. But it wouldn't be surprising to see, our sales volume, which has already dropped nationwide, to continue to drop to maybe a 10% drop off of, its high peak. But, when we average about 5.5 million homes a year, typically, I think, and we had like 6.2 or 1 million last year, well, it's to be expected to see a little bit of that ebb and flow occurring. And so it's a natural part of the process. But at the same time, there's just no inventory available. So it really won't be reflected in price drops as much as just demand drop a little bit.
Absolutely. We'll get into that a little bit more. This one was fascinating, Jim. When Jim pulled this one for us, and I'm like sitting here, I'm like, well, what are these places in the country that have a very high chance of price drops? Yeah. But it's like real few and far between. I mean, look at the bulk of the country. The bulk of the country has seen record appreciation for years now, especially through COVID. Some places 20% plus a year, and they're all ranked at very low chances of, going down in price over this. It looks like the Pacific Northwest is going to struggle just a little bit in the coming years. And it really looks like we were talking about the kind of that New England area is also looks like it has a potential of struggling through this downturn. But I mean, I'm pretty impressed. There's a lot of blue on this map.
Well, and most importantly for our audience, it's Colorado is looking very healthy, very low odds of home prices dropping. So this is encouraging. And I think what's more encouraging too is the fact that prices appreciation is starting to slow down a little bit. So it's that train naturally coming to a stop as it approaches the station, kind of thing. So that's, I think, part of the reason why this is going to continue to be, a healthy thing with a very low risk of any kind of bubble popping.
Yeah, absolutely. All right. So what about showing time? So the showing time gives us that 60 to 90 day out view, right, Jim?
Yeah, it does. It does. And, we can see that there's been a drop in showings. This is March 2022, right when interest rate increases really were starting to impact things. And so it did put the brakes a little bit on it. But Anthony, we've talked about this over the years here at Front Range Facts. And, we've seen this happen when interest rates, I think in 2019 went up, from like 3.5 to 5 within a month, where, there's about a 3-month period of time where people freak out, they put the brakes on things, they start to question reality, but then, it becomes the new normal. And I think more importantly in this market than last time in 2019 is that there's very good reasons why the interest rates are up as high as they are. And there's very good reasons to expect that they'll go up even further as a way to kind of combat that inflationary effect we've seen across all different industries in the United States.
Absolutely. So that wraps up our portion on the national part of the market. We're going to get into state and local markets here in just a second. But of course, we need a shameless plug, because how do you know who we are if we don't? Right?
We don't. Who knows?
That's right. I'm Anthony with Land Title. You can always reach me on my cell phone, 303-968-9868, or at ameisner@ltgc.com.
And I'm Jim Merrion, realtor here with Coldwell Banker. My phone number 303-548-0243. And always feel free to shoot me an email at jim@ourcoloradohomes.com.
Don't forget, you can catch us on the other podcasts we do, Get Real with Blockchain, anything you want to hear about cryptocurrency and blockchain in the market. And we do that one from time to time, anywhere where you get your podcasts. You can always reach out to us here at the show as well at frontrangefacts@gmail.com if you want our slide deck or you just want to chat about the market.
And Anthony, it's important, I think, to let everyone know that we will be teaching a class on cryptocurrency and blockchain technologies for real estate next week, May 31st in Summit County for the Summit County Realtors Association. So if you have the opportunity to join us then, we'd love to meet you in person.
Yeah, we'd love to see you there. All right, so let's get into Colorado. Colorado specifically, we talked a little bit about showing time here nationally and then what to expect, but Colorado is really seeing a drop in showing activity, right? Mm-hmm. And yeah. A lot, and this is up to date. So I pulled this morning. This is right now. So basically their baseline here, when you look at this chart, is January 1. Well, we have less showings than we had in January 1. Does that really surprise anyone? It shouldn't too much, because we have a lot more homes on the market. We effectively have reduced our buyer pool through rising interest rates since, call it, most of the year, but really quickly starting at about March, right? So it doesn't really surprise me that we're starting to see a decrease substantially compared to last year, but that's okay in a lot of ways. partially there just isn't enough homes on the market. So that's going to reduce showings in itself, right?
Yeah.
But the other part of that being the interest rate rise. So this is not anything to panic about at all. It's just the baseline was set at 2021 January, which is a lot of showings, right? I mean, people really came to market fast this year.
Well, and it's one of these things where we have less showings now, but what we still have is high quality buyers who are very motivated to make offers. So the amount of showings to offers is stronger than it was with more of the looky-loos coming through.
Absolutely. And I think the big takeaway is when you talk about it in the perspective of, it may be down close to 50% from this time last year. You went from 20 showings on a house to 5 showings on a house, but all 5 buyers that were there were absolutely very motivated to be there. So it's a really different conversation than, the other way around, where you hear stories of people going like, yeah, we just shut it off after 100 showings. We had so many offers we didn't know what to do with. Just a very different market when you still have competition taking place in the market.
Absolutely.
All right, so let's look at Colorado. This would be this stuff that comes straight out of the Colorado Association of Realtors. So this is the whole state. New listings are still doing remarkably well. They're up 4.5% year over year, which is really good. We're basically right on pace with where we were last year as far as new inventory coming to market. So what has really changed? What's really changed is the buyer side of the situation, right? The pendings are down about 6%. There's not enough inventory for them to purchase. That's been a consistent problem. Because there's not enough inventory, and because there are plenty of listings coming to market, you're seeing median increases of like 18.4% year to date, almost 20% April over April, which is, that's bananas, right? We're starting to see this slow down though. So expect this to not continue for the rest of the year, but we've kind of reached the pinnacle of the market in April, I think is where we kind of want to frame this in Colorado. Average sales price though is only up 13.2% rather than 20%. So slowly we're reeling it back in a little bit, which is probably healthy for the marketplace. That percentage list price to close price is 105%. I mean, unbelievable, right? This is the highest it's ever been in Colorado. And it's a good thing that that's starting to ratchet back, because that was definitely an unsustainable number. The good news is though, I think if you're a buyer or a seller, with things kind of tearing off a little bit, that first quarter and that first 4 months is really going to give you a good baseline to get things to appraise. It's really going to give us, a good baseline to kind of feel a little bit more stable in the marketplace underneath us as we're kind of ratcheting back some of that buyer demand. The interesting part though in Colorado, and this is very different than nationally, the days on market until sale are down to 24 days on market from 30. So we're actually 20% faster this year on market, which means the buyers that are active, even though they're slowing, are really, really hungry, right? Like they might have had they might be a lot of people in buyer fatigue, but the people active in the market are putting stuff under contract faster than ever before. So,
and this is also, I think, a reflection of all the changes that the mortgage industry underwent during COVID to try to be more nimble, and have less time spent like sending appraisers to homes. They've done more desktop underwriting where they just underwrite from a computer algorithm. Things like that have really shortened the time frame for some of that. So I think that plays a role in it as well.
Absolutely, it does. So let's take a quick look at the condo townhouse market for Colorado. And this is one where attached feels like this in Boulder County too, where we're at, and there just isn't as much inventory coming to market, right? We're down 10% in new listings. Because of that, you have owner contracts going down, you have solds that are reduced because of that, right? We're kind of 10% down in the whole market there. That's driving a ton of a price appreciation that we didn't get over the last 2 years in attached into attached this year. So expect that they're acting a little different right now. And I think that's going to continue quite a bit with the reduced amount of supply coming to market.
Yeah, and I think just the fact that the townhome condo market has average sale prices now approaching 550 statewide, that's stunning.
It's stunning. Yeah, and you can really see it here. The bidding wars are actually more extreme in the attached market than the detached market, which is the first time that's happened since we've been on this podcast. But honestly, probably the first time in my real estate career that's happened. It's been a long time. Getting old and wise these days, right? Since we've gone through that slowdown and the 08 bubble. So here we go. This is one thing that I thought was really interesting. The inventory of active listings is down 40% in the attached market, right? That's a pretty extreme swing. Definitely worth noting. So let's move over to a couple of new things. There's really a few things I wanted to talk about on a state level that I think are worth noting. New listings, this is one that is really worth focusing on because even though we're talking about some sort of slowdown nationally, Colorado's market is seeing just an incredible number of new listings coming to market, right? I mean, new listings are pretty consistent with any time spring behavior, right? So that's a really good sign. You're seeing 10,000 new listings come on in April. Last year, there was 10,000 listings, right? In 2020, because of COVID and everything else, that was dramatically reduced. But the townhouse condo market's the same way. We have a ton of active units coming on market, right? That's a really good sign.
Mm-hmm.
The days on market until sale is the extreme part. This shows you, even though we have a reduced buyer pool because of interest rates, they're moving so much faster, right? I mean, we're down to 24 days instead of 30 days last year. If you could look over the history, right, look at 2010 to current. I mean, it's done nothing but speed up. The market has. So,
And
Colorado,
I'm shocked. What shocks me is that we're still seeing a decline, just because we had a pretty tight 30-ish day kind of process before, and really just again circling back to that idea that the lenders have really changed the game with being able to cut a whole week out of the closing process. It's just amazing that it makes it continue to drop in that regard.
Yeah, I mean, I have a lot of lenders telling us, once they get people pre-underwritten, they can close in 14 days, they can close in 15 days, right? Like these are pretty extreme changes from the 30-day market we were in pre-COVID. So yeah, that's interesting stuff. This is the one though in Colorado, and we showed you the national stats where affordability was becoming an issue. We're talking about appreciation slowing and really how that's going to affect things. The good sign with appreciation slowing is it should help out with this affordability, right? This index was based on like a baseline of 100 at one point, and we went through huge swings because of 08 moving up into 2012 when we had a lot of release of inventory in the market, and it just became really, really cheap to buy houses because we had this huge influx in inventory. That was the most extreme buyer's market we'd seen in a very long time, and we basically chipped away at that inventory so long, and we haven't built enough homes that Colorado price affordability has dropped every year. And because of the last year and rising interest rates again, now we're at 51 essentially. So
yeah, well, I think it's important to note that us and everyone else out there has indicated that when prices go up like 20% in a year, it's not healthy from a long-term sustainability perspective. You can't continue to have that kind of record level of growth without having a negative impact on affordability. And that's what we're seeing here is that precipitous drop in affordability, which is reflected not just in home buying, but also in rentals. The rental market is very similar in this regard. There is no good answer if you're trying to find housing in Colorado and money's tight for you, because everything has gotten so much more expensive. But the great news is that these, deflationary things the Fed's trying to do, where they're reducing the amount of home growth appreciation over the next few years, that is going to help bump that back up. So I think we're looking at essentially like a low watermark with affordability, Anthony, in this slide.
It sure seems that way, right?
And I think we should expect to see it start to rebound and move back to more of an affordable environment for people.
Yeah, or at least flatten out for 2022 and then start to rebound in the years to come, which is a good sign.
Yeah.
All right, so that was Colorado. We're going to get into the local markets here in a second. I'm Anthony with Land Title. You can always reach me at 303-968-9868 or at ameisner@ltgc.com.
Sorry about that, Andy. Jim Merrion here, realtor with Coldwell Banker, 303-548-0243. And I'm Jim at ourcoloradohomes.com. And we've got a number of slides, but we just want to make a quick dance through them a little bit to illustrate a few major talking points.
Yeah, so Denver Metro is really similar to Colorado in a lot of ways, but the biggest thing, rising inventory, right? Which means added pendings because we've been at this low watermark for so long. It's a really good sign. It's going to slow down that appreciation level. This is a killer time to be a buyer because you're finally going to see some inventory. It feels exciting compared to the last few years, right? We really like to see that. It's very healthy for the market. The big thing though is when we look at it by price points, lots of activity in the luxury section, almost nothing happening below 500,000. We just have a huge reduction in affordability there. So a lot of those have actually just been bumped up in price, right? A house that used to be 500 is now 600. A house that used to be 300 is now 400. So that's kind of a shift in the market there. But the biggest takeaway, I think, in the Denver metro market the speed of the market, right? And we keep saying this, but that days on market is down so low, and it doesn't really matter the price point too much, right? You can see that under 300, there's just not a lot there. So those aren't move-in ready houses a lot of times. And same with 3+ million. There's a lot to be unpatched in the luxury market across Colorado, but the speed of the market is really extreme and it's very fast and still speeding up into the summer, right? And that happens traditionally in a seasonal market, but you are seeing rising inventory. It's still frictional, right? Even if a house sits on the market for a week or two, it's really not a concern because it just means we're getting back more towards a more balanced market, which we've been on this huge swing to sellers' favor, right? Lastly, in Denver Metro, the biggest takeaway, that percentage sold price to list price, we talked about in Colorado level, it's close to 105%. In Denver Metro, it's 107%. It's really extreme. April was the peak, right? We don't normally reach the peak in April, but because of rising interest rates, because of the situations, it's really dialed it down, right? So here we are, 107%. We hit our extreme early. We had lots of bidding wars, but I think the biggest takeaway, the most bidding wars took place between 1 and 2 million, right? This is just showing you how extreme it is in Colorado, how many people are moving here, how much money's in Colorado, and just this market is very different than it was pre-COVID.
Well, and to see an average of almost 9% over asking price in that $1 to $2 million range, I mean, we haven't seen that number in any data ever. I mean, that's the highest ever. And to see it at this level, that 1 to 2 million, certainly it shows that there's a higher end aspect of this market where they're immune to interest rate increases. It's not relevant in their conversation or thinking.
Yeah, and their confidence in the Colorado market is amazing. So I think that's the other part is you have to remember that $1 to $2 million buyer is a very different buyer. A lot of times they're highly educated, they're business owners, they're like thinking about a lot of other things, but their confidence in the market should say a lot to us in Colorado because you're probably not seeing that in a lot of markets. Let's move over to Larimer County, Jim. So this is one that you pointed out to me, and I cannot believe where our average sales prices are in Larimer County. This is unbelievable.
Yeah, to see almost 700,000 now for Larimer County. Whoa, what the heck happened? Well, what happened is that the prices have gone up 28%. I mean, in 1 year, 28% in Larimer County. There's been a lot of new construction that helps to drive some of that. But there's no rhyme or reason other than the fact that, inventory sinks and there's more people who want to move out than there are homes available.
Yeah, so here's the supply side of the situation. This is for all of the sellers out in the marketplace that are considering active listings are still at an extreme low. It's very different than what's happening around the state or in Denver Metro. The new listings coming to market are still really extreme, but this just goes to show there's a lot of buyer demand and a lot of buyer behavior up there, putting stuff under contract fast. But they're still 10% below where they were this time last year, and we've been below all year. People are holding on to inventory more. Then when you get over to the buy side of the situation in Larimer County, pendings are going as fast as they can. They're really restricted because of supply. That's really what we're seeing here is buyers are active, buyers are looking, but we're still at 0.6 months of inventory. They're still one of the shorter supply lines in the whole state, and Northern Colorado, because of this, is just booming.
Yeah, oh, for sure.
What about Weld County, Jim? It's pretty
well,
similar.
not quite as extreme with the appreciation. We're only at 19.5% appreciation for the average sale price. But it's another one of those things where there isn't a lot out there. Overall demand is still up really high and people are always looking for the more affordable areas. Weld County has certainly scratched that itch for people in the past where it's been a little bit more gentle than say Boulder County or Larimer County with prices, and so it falls into that nice sweeter spot for people.
Yeah, the other part about this is the Weld County market is growing so much that we're at 745 new listings, which is really similar to what Larimer County has, right? It's a big market. The last year numbers were 22% above this. It just seems to bounce around a lot more in in Weld County. It also isn't so extreme in those summer seasons when you see inventory come to market. It's a little flatter, but inventory is so short, right? Look at the
yeah, I mean, they have more listings in Boulder County, but still it doesn't, help them at all, because the demand's just so high there. Yeah. And so, pending listings have dropped 20%, because the fact that there's, a lot less inventory.
There's just nothing there to buy.
42% less inventory equals a drop in pendings, that's what happens.
Exactly. The other thing about this market, I guess here's Boulder market. Let's get in the Boulder market because it's next proximity. And Boulder County is at 1.2 million for average sales price. It's still rising pretty rapidly. It's definitely slowing. And it's part of that is due to just the affordability in this marketplace. But look at the median. The median's almost $1 million now in Boulder County for single family homes, which just is what it is. Very desirable marketplace, right?
Yeah, I mean, we'll break $1 million for the median within a 12-month period of time.
Absolutely. The supply here in Boulder, 352 active listings on market. So it's about half the size of Weld County. But the thing is, you still have new listings coming to market real fast, right? 600 new homes came on the market last month. That's a really good sign. It's becoming very healthy. Sellers are very favorable in this market, which still looks great. But if you look at the demand side of it, our pendings are still restricted because of that, right? We're still at 0.8 months of inventory. Balanced market's 4 to 6 months. So all of this Northern Colorado market is just doing remarkably well, but really, really restricted by its inventory situation.
Yeah.
Jim, what's going on in Colorado Springs?
Oh, well, Anthony, I mean, it's, continuing to be a real solid market in that regard. And this is, the new listings are up 3.6%, year to date, which is great to see. Pendings are up 5%, and sold listings, about the same. It hasn't been much of a change, but the median sale price up 16.7%. So another great year of growth for the Springs area.
It just really seems like the Springs are right in line with what's going on in Northern Colorado now, and it never used to be like that. I mean, you can see it in the attached market. Same thing's happening down there in attached. There's not enough inventory. Prices are rising much faster in the attached market than the detached market right now, which we really haven't seen either. So similar situation up and down the entire Front Range, which is pretty amazing. Last thing we wanted to touch on before we stop, though, was Pueblo, because we haven't talked about it in a while. So Jim,
I mean, it's a secondary market. It's on the very south end of the Front Range as far as we're concerned. But new listings up about 13%. Solds are actually up by 8%, which is they've got a better inventory situation than we do. But their median sale price has increased 18.7%. So very much in line with that whole overall lift of the Front Range market. And days on market till sale has dropped a little bit as well, but they are longer in the tooth with a time frame to get sold than they are, in the greater metro area.
Absolutely. This kind of shows that it's very much a hockey stick market, like a lot of the Front Range. Pueblo is kind of following suit, but we wanted to touch on it for our friends in Pueblo because we don't get to do that too often, and we're always kind of paying attention. So I'm Anthony with Land Title. We just want to say thank you for joining us today. You can always reach me on my cell phone at 303-968-9868 or ameisner@ltgc.com.
And I'm Jim Merrion, realtor here with Coldwell Banker. I'm at 303-548-0243, or you can shoot me an email at jim@ourcoloradohomes.com. And don't forget, if you're in Summit County next week, to go to the Summit County Association of Realtors and check us out on June 1st.
Thank you. Have a great one.
Take care. Thanks.